This video is going to look at risk and reward. Hello, once again, I'm Peter Martin with Trading 212, discussing risk and reward ratios. Now, I thought I'd put together this video to give you some of my thoughts on the subject, just because I've noticed that traders that are new to the market can often get a bit hung up on chasing specific ratios or actually misunderstand where risk reward is most useful. So the first thing I want to tackle is the idea of using a specific ideal ratio to instruct you on the creation of a trade, because my view on this is that there's actually only very limited use in doing so. In a general sense, it can be very sensible to only consider taking on a trade where there is sufficient reward on offer for the risk that you're being asked to take on. But in terms of focusing heavily on specific ratios, I think there's limited use in doing this. So let's get into this. Often we hear bandied around that you should only consider a risk-reward ratio of, say, 2 to 1 or better. And the classic argument put forward to illustrate this is to consider a clearly range-bound market in which the market price is oscillating between a lower range and a higher range. And the argument goes that you would buy in at the lower range, say, and let's say that the upper range is 50 points away. Then you would put a stop 25 points below, and you can say that I'm aiming for 50 points of profit, and I'm taking on 25 points of risk, and therefore my risk reward ratio is 2 to 1, which is good, and that's what you should be aiming for. Now, my primary gripe with this is that it doesn't take into account probability. I would argue that the difficult bit is identifying correctly that the market is range bound. If we're confident that it is, I would contend that most people who are sensible, most of us using common sense, would be able to sort of just work out a profitable way of trading it, that we're aiming to sell at the higher end of the range and then we're looking to buy in at the lower end of the range. And where it comes on, really the crux of whether it's profitable or not is whether this happens or not, the probability of the trade actually yielding a profit. Now, risk reward doesn't look at that in that way that we just discussed in terms of trying to set up a trade. But also, just a kind of broad brush ratio of a number like 2 to 1 pays little or no attention to individuality of trading style. The strategy that we just described of trading the oscillating market is a counter-trending strategy. It's selling when it goes higher, buying when it goes lower. But many people employ trend-following strategies, which is the opposite, where you're looking when it gets to the higher end to see if it continues, if it breaks out of that range, and then jump on it in the hopes of making a much, much bigger profit. And then obviously one of the drawbacks with that style is that often markets don't, when they break out, go on to form new trends quite often, so that if you're employing that trading strategy, you may end up with lots of little losses if you're using it correctly. But the idea is that every so often you will hit the mother lode, make a big profit that outweighs all the little losses when it didn't work. And if we look at that, if we look at how you're trying to quantify your profit there, really, you're not ever trying to sort of draw a line under your profit. The idea is to string out your profit as long as you can, to just keep going, and you're responding to what the market does. So effectively the market is dictating your reward, and there's no way to sort of construct that strategy in advance by trying to artificially look at where I'm going to take a profit. And in fact, if you did put on a take profit level, a limit order, you'd actually be constraining your profits, and it would be counterproductive in that strategy. So where is risk reward most useful? Well, let's look at where it comes from. It actually stems from the world of fund management as a way of comparing performance between funds. One of the most commonly used risk reward ratios in the world of fund management is the Sharpe ratio, and it came out of the mutual fund market, and it looks at annual returns and it divides it through by the standard deviation, which is a statistical measure of the dispersal of data, how widely spread it is. Really, it's saying how much the profit and loss of that fund varies. And so you're looking at lots of different funds. They can all be showing very good returns. It can be difficult to try and identify which is the best one. Adjusting for variance in this way is a good way of adjusting for a form of risk, and it allows you to sort of get a very easy broad metric to say, okay, this one is better. Of course, it doesn't look at all types of risk, but how can this translate into the world of CFDs and Forex? Well, we can use a similar concept to compare different trading strategies. Let's say that we've got a couple of trading strategies, both show profit. How do we know which one is the better of the two? Well, as long as that they're sufficiently similar to make a comparison sensible, we can look at, say, the aggregate performance over a certain period, let's say 6 months, and then we divide through by some measure of risk. Let's say that we decide our measure of risk is the maximum running loss that each strategy yielded over that period. We divide through by that, and that will give you a risk-reward ratio, and the one with the higher ratio, the one that had the lower risk, in comparison to the rewards it yielded, would be the one to follow. So it's a way of, sometimes we can just get blinded by the sort of overall profit, but risk-reward ratios allow you to sort of adjust that for how much risk you're taking on. Now, it's certainly sensible in a kind of general sense to consider if there is sufficient reward for the risk that you're taking on. So I'm not just poo-pooing the idea completely. I think that really we need to understand where it's most useful is actually in comparing strategies rather than in constructing strategies. But by all means, of course, you must always consider that you're trying to maximize your rewards, you're trying to minimize your losses. So by all means, try and constrain your risk, try and get as much reward as you can. So that's just my 2 penneth on the world of risk and reward ratios. I hope that you enjoyed the video. If you did, please hit the thumbs up button and give us a like. If you disagree, if you've got any feedback, you've got any thoughts on the matter, send us a message in the comments section. We do read through every single one. Keep an eye out for other videos that we've got coming out in the near future. I'm intending to do a video on gold this week. So if you hit the subscribe button, you won't miss out on any of those. But that's all for now. So from me, Peter Martin, and Trading 212, let me wish you the best of luck with all your trading, and I'll see you next time. Goodbye.